We've spoken a lot about the distribution of a dividend amount by a company to a shareholder and what the consequences are for a company, how we calculate the STC, etc. But what we must do is realize that every amount that is distributed by a company to a shareholder will have consequences for the shareholder themselves. So what we want to focus on now is the shareholder in this transaction. Remember, the shareholder is going to be the owner of the shares that they hold in the company. So those shares in the shareholder's hands are their assets. So just like we have to do with any taxpayer that owns an asset, we have to say in what capacity does the shareholder hold those assets? Does he deal in the assets such that he holds them as trading stock? And in respect of a shareholder, we will call him a share dealer. Or does my taxpayer look at those shares as an investment asset, i.e. he's holding them for the dividends that he's going to receive on those shares, and this is then known as an investor with shares. Now, when we're looking at the shareholder, that is probably one of our most important starting points, is to say, Mr. Shareholder, what are you? Are you a share dealer? You buy and sell shares? Or are you a share investor? You're holding those shares for the dividend income that they are going to produce for you. Now, if your shareholder is a share dealer, let's just have a look at what can then relate to that share dealer. Remember, your share dealer is buying and selling shares as trading stock. So he buys shares, he claims an 11A deduction like we do for trading stock. When he sells the shares, he has a revenue receipt, and that will be going into his gross income to finally become part of taxable income. So that's our share dealer. But what a share dealer has to also say is there are going to be instances where a company enters into a share buyback. Now, a share dealer in a share buyback, like any shareholder, is then selling his share to the company. So in a share buyback, company approaches the shareholder and says, I want to buy back your share. So the shareholder disposes of the share. So a share dealer disposing of a share in a buyback is going to be disposing of one of his pieces of trading stock. So what we have to say is when there is a share buyback by a company, any amount received by a share dealer for the share buyback will be a revenue receipt. So the share dealer in a share buyback gets revenue. He will deduct from that the cost of his trading stock, whatever those shares cost him, and he'll be taxed on the net amount. What about a share investor? We're going to look at a share investor slightly separately because the share investor is holding his shares as a capital asset. So he will also have a disposal in a share buyback, and the amount that he receives for that disposal will be proceeds for CGT. So we'll look at our share investor in a bit. But before we leave our share dealers, what other section is really relevant to a share dealer? We must look at section 9 capital C, because what 9 capital C does is it goes to the share dealer and it says, those shares that you are holding as trading stock, if those shares are regarded as what will be called a qualifying share, then 9C says the share is no longer trading stock but has become a capital asset. So a qualifying share is a share that the shareholder has held for more than 3 years. So when we're looking at section 9 capital C, we've got to go to our share dealer and say, what shares have you held for more than 3 years? Be careful of 9 capital C. It's an automatic section. Not like one of those sections where you've got to choose, you've got to elect that it applies. 9C is an automatic section. So the moment you hold a share for more than 3 years, that share becomes a capital asset in your hands. And 9C talks about shares held in private companies and listed companies. So 9C then says, right, this share has become a capital asset such that when that share is disposed of, you will get proceeds and have to subtract the base cost of the share, the para 20 expenses in respect of that share. But that's not all, because when 9C comes into play, what's happened to our share dealer is automatically, after a share is held for more than 3 years, that trading stocks become a capital asset. So what the share dealer has to do is they have to add back all the trading stock expenses that they claimed in respect of that share, which has now become a capital asset. What I want you to be aware of, though, is when we in a past DVD looked at trading stock, we looked at section 20.8, which said when you have trading stock and that trading stock changes and becomes a capital asset, then we have to add back the market value for most cases of that trading stock. Now be very clear that what they call the recoupment provision in section 22.8 does not apply when section 9C is activated. So when 9C activates, all our shareholder has to do, who's now gone from holding trading stock to holding a capital asset, is in the year of assessment that 9C applies, that expense that he claimed when he purchased those shares as trading stock has to be added back. And what he will do then is take that expense to become his new base cost for the share, insofar as those expenses meet para 20 of the 8th schedule. So a share held for more than 3 years, then we add back any expenses claimed when the share was bought as trading stock. Now we take those expenses, what of those qualify as base cost, para 20, and then when that 9C share is sold, we get proceeds minus base cost, and there will be a gain or a loss. So watch out for 9C. So 9C doesn't override our general rules about an investment intention versus a scheme of profit-making intention for shares that are held for less than 3 years. But once a share is held for more than 3 years, a share dealer is deemed to hold that share now as a capital asset. So 9C can be a great thing for a share dealer or a very bad thing for a share dealer, because remember, if the share dealer holds that share for more than 3 years and then sells the share, should a capital loss arise, that capital loss can only be set off against future capital gains that a share dealer might make, and not decrease any taxable income that the share dealer has made from dealing in the shares. So be careful of 9C.